Corporate Finance OneNote practice problem. In this presentation, we're going to work a practice problem in OneNote related to a schedule of cash receipts. We're going to have multiple scenarios for our schedule of cash receipts. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 428 Schedule of Cash Receipts Multiple Scenarios tab in the Practice Problems section. Closing this back out, we're going to have our information up top for the first scenario, and then we'll have a shorter recap of that information as we work through the practice problem. Same format for the other of the multiple scenarios we will be taking a look at. We're looking at the cash receipts schedule, so that means we're looking at the actual cash flow, the cash inflows, the receipts of the cash inflows. So we're going to need then the sales projections in order to do that. We have to have the sales projections in order for us to think about the cash flow that's going to be inflowing. Our sales projection numbers are here. We have March, April, May, June, July, August projection on the sales. Then we also have the actual sales that took place for January and February. Why do we need the actual sales for January and February? Because when we think about the cash flow, even though the sale took place in January and February, if we made some of those sales on account, then we might not collect the cash until the periods that we are looking in, which is going to start in March. So remember that we're doing the flow assumptions, our schedule, the projections out into what we assume cash flow and receipts will be from March to August, but we're going to include then January and February periods that have passed in our schedule to help us to figure out what the collections will be on the sales for those periods. So we have the percent of sales uncollected is going to be 10%, meaning of the sales that we make on account, meaning we didn't get cash at the point in time we made the sale, we sold something on account, we gave an invoice, we put the information into accounts receivable, we expect to collect them in the future. 10% never get collected, we don't get to them, people disappear, and we never get the money. It's sad, but that's kind of our average, and we push forward. And then percent collected in the month of sale. So we make the sale, and we're getting cash in the same month. So we can assume here that we made a sale on account, we invoiced the client, and they pay us within the same month that we invoiced 35%. That's our assumption. Percent collected in the following month, meaning we did the work, we invoiced the client, we have them in accounts receivable, we try to collect on that, and we don't get to be able to collect on it till the month following the month in which we actually did the work, made and sent out the invoice. Then we have the percent collected 2 months after the sale, meaning we did the work, we sent out the invoice, took 2 months before we were finally able to collect on that. 30% fall into that category, which is kind of high. We're working on lowering that and increasing our collection and accounts receivable turnover. The fact that that's so high is probably why we have a fairly high, percentage of sales that are uncollectible in total. But that's another story. That's what it is for now. So we're working on that being better. But in any case, now we're going to figure out our cash flows based on that information. Here's a shorter recap of that information to work through our practice problem. So here we have it. Here our cash receipts schedule. I would highly recommend doing this in Excel as well. We do have these problems or similar ones in Excel. These are great tools to just work on your standard formatting in Excel. Great tools. So we have January, February, March, April, May, June, July, August, July and August. We're focusing in on March through August for the cash receipts. We're going to add January and February so we can standardize where you see where the numbers are coming from in our table. If we were to do this in Excel as well, we would want to standardize the formulas, which we can do more easily if we include January and February. Remember, January and February are the periods that have passed already, but we're including them in the table for purposes of calculation. So we're going to start with the sales line. This isn't cash collections. This is when the sales took place. This is when the invoices went out. This is when we did the work. We have January through August, which is coming straight from our data here, the sales projections numbers. We need the sales projections before we can project out the cash flows and the cash receipts. And then we have the January and February. These are the actual sales that took place, which we are including. Then we're going to say collections. That's where we want to focus in on. We have the month of sale. In the month of sale, we're collecting 35% in the same month of the sale. So that one's pretty straightforward because we're working in the same column. Meaning I'm just going to take, all right, there's a sales number, 45,000 times the 0.35 gives us the 15,750 And then we're going to pick up the 57,000 times the 0.35 is the 19,950, and then so on and so forth till we get here. And then we have then the staggering kind of issue we have with 1 month after the sale. This is why we have March in place here. This is why we have January and February so that we can calculate them for March. So we have the percent in the following month that we're going to collect on. Now we have to do this staggering thing. So I need these two numbers. I need February that's when we made the sales, but we're going to collect part of it over here in March, we're assuming. So we're going to take the February number, 38,000, and we got to stagger it on over to 0.25 to get us to this 9,500. Same process here. We're going to say now we have March's number, which we're going to stagger on over here. So we've got the 45,000 times the 0.25, and that's going to give us the 11,250, and so on and so forth. So now we're looking at this number. We're going to use this number to do so. April to calculate May. So 57,000 times 0.25, and we got the 14,250. This should look a little bit unnatural for a table because normally we don't like to be like jump into a different column here. I'd like to stay in the same column and then like a row thing, like from this row and this column is how the table should work. But because of the staggering issue, we're taking it from a prior column. You can copy over the formulas still nicely in Excel, so I highly recommend doing this in Excel to see what it looks like in that format. Then we have 2 months after, percent collected 2 months after the sale, 30%. So this is why we have then January here. Notice we're not doing any calculations below January and February. We only need this data up top for use in the period that we are looking into for the cash receipts. So now we're going to say we have this 42,000 for January. We're going to pull that out 2 months later, multiplying times 0.3 or 30% to give us that's 12,600. And then we're going to go on over here 2 months. We got the February number. We got the 38,000 times the 30%, 0.3. That's going to give us our 11. Let's do that one more time here. We've got the 38,000 times 0.3 is going to give us our, yeah, that's right, 11,400. I don't know why that was. And then we've got the 45,000 times the 0.3 is going to get the 13,500, and so on and so forth as we go through. So you can see how that process works, but when you just look at this table, it doesn't really register to do that kind of staggered format. Then if we were to add these up, we have the March sales, which include or March cash receipts, which includes the receipts that we had for the sales we made in the current month, the receipts we had for sales we made in the prior month, and receipts we had for the sales we made 2 months prior. But the cash receipts being the 37,850, and that same summing function all the way across again. Very good practice in Excel to work this problem in Excel. So now we're going to take a look at our next scenario, and as we do this, the first part will be the same, and so I'm going to go through that quicker, and then we're going to do a table down here to figure out the accounts receivable activity. So you can think about the activity in the accounts receivable as we go through this, and we'll talk about the amount expected to be collected, meaning we have this 10% that's not going to be collectible. So once we think about the receivable, how much of the receivable amount at the end of this whole process is expected to be collected. So we'll do this a little bit faster here, this first part, because this is going to be similar. So we have similar data up top, the sales information for the period that we want to project. These are the projected sales, the sales for the 2 months that have passed, and our collection process, or when we think things are going to be collected. So we then have the credit sales that are being made. So credit sales for January here and February, and then March through April, the projected amounts. Same process in that January and February have already passed. Those are just informational numbers. Then we're going to have the items that were collected in the same period. So we're going to say then that we have, these are the ones that are straightforward. I'm trying to get the calculator here and it's being stubborn. In the same month, so we got the 55,000 times the 0.35, we're going to assume are collected in the same period, and that would be the 19,250, 60,000 times the 0.35 gives us the 21, so on and so forth, all the way through August. Then we have the slightly more complex scenario, where we have the items that we're collecting on the month after. So February, the amount of February credit sales that are collected in March are then going to be that 45%. So we'll then be picking up this 62,000 times 0.45, and that's going to give us the 27.9. And if we move that on over here, we're going to take the 55,000 times 0.45 for the 24,750, and then so on and so forth for the 60,000 times the 0.45 is 27,000. All right, and then we have the items that are going to be collected 2 months after the sale. So now that's why we have the January numbers here. So we got January being 63,000 times 0.1. That's going to give us our 6,300. And then we have over here, we've got the 62,000 times 0.1. And that's going to be our 6,002, and so on and so forth in a similar process as our prior presentation, our prior problem. And if we sum up the 19,250, the 27,9, and the 6,300, we get the 53,450. And again, we're summing this across all the way across. Now, this is going to be the cash flow activity. So you might then ask, well, what's going to happen in the accounts receivable? Now, we're gonna put a little bit of a variation on this, because notice there's going to be a beginning balance in accounts receivable. So what we're going to say here is, let's just assume that let's pretend accounts receivable started at 0 as of March, and say of the sales that we had in the time period we're covering, March through August, how much would still be uncollected for that time range. So that means we're going to negate or take out the beginning balances, because obviously accounts receivable would have a beginning balance before that time. So given that number, so if a question asks, say the question is going to be, all right, of the sales that happened from March through August, how much would be uncollectible or still in accounts receivable of those sales at the end of August? And then how much of those do we expect to collect, given the fact that 10% we're assuming is not going to be collectible? So for that, we can set up kind of a running balance type of schedule. And this is another really good practice to do in Excel. So what I'm going to do is I'm just going to set up the sales numbers. So sales numbers columns, I'm just going to set up the 50, the 60, the 49, the 50, and so on in the sales column for March, April, May, only the periods that we're looking at. So this basically column, we're going to be here. And then we're going to look at our collections. Now, the collections are a little bit tricky because I'm only talking about the collections for the period that we're covering starting in March. So the collections here were 19,250. Where did that come from? It's coming from this number, 19,250. We're not putting 53,450. Why? Because the 27.9 applies to February sales, not to the sales in March, and the 6,003 applies to January sales. And we're trying to see of the sales that happened starting March, how much has not been collected. So of those sales, we're saying we collected 19,250. 55,000 minus 19,250 means that the AR accounts receivable balance has 35,750 in it related to sales in the time period we're covering, including March. And then in April, we had sales of 60,000. We're going to say that we collected 45,750 of those. Where does that come from? Well, now we're going to say that we have the 21 from the current period. Those were collected for sales made in April. Plus, we have the 24,750 for sales that were made in March that were collected in April. And then we're not including the 6,200 because they were sales that were made in January. So we've got the 45,750. And then we have our running balance over here, meaning what was the change? The change that happens was 60,000 sales minus the collections, 45,750, means the accounts receivable is going to go up by the 14,250. And we already had a balance in it before of the 35,750. So plus the 35,750. And then we have our 50,000. So this running balance kind of calculation, really useful to be able to do. It's really easy to do in Excel too. So I would practice doing that, because you can just copy, you can copy the formula down for it really nicely. So then we have the next period with the 49,000, and now we're collecting 49,650, which is straight this number in all the collections, because that works now, because the 17th 150 is from May. The 27,000 are from sales that were made in April. The 5,500 were from sales that were made in March. So we can now take the full 49,650. So now we've got the 49,000 sales minus 49,650. We collected more now than the sales that we made. So that's actually a decrease in the accounts receivable. And then I'm going to add that negative number to the 50,000, giving us the receivable balance of the sales made in the time period we're covering, starting in March, 49,350. Then we've got the June numbers. Once again, the sales number here, and then the collection number is going to be the 48,350. So then we're going to say, all right, so now we've got another sales, 58,000 increase in accounts receivable, minus the collections we collected on them, 48,350, which is coming right from our table. That's our difference, our net increase in accounts receivable, plus the beginning balance, what was in there before, 49,350. That gives us the 59,000. So then we have in July, we have the 67,000 here. We have the collections in July, 54,450. So if we then take the 67,000 minus the 54,450, we get the 12,550 increase plus the prior balance plus the 59,000 is the 71,550. Let's do it one more time because that's all we have to do. The fun has to stop sometime. So we've got August. August is going to be the 70,000 we collected in August, 60,450. So we have the increase we have the sales, which would increase accounts receivable, 70,000, minus the collections, decrease in accounts receivable, 60,450. Net increase in accounts receivable would be 9,550, plus the prior balance, 71,550. That's going to give us our total 81,100 in accounts receivable of the sales that are in the period that we are looking at that starts in March through August. So now of that amount that would still be in accounts receivable, how much of it do we think we're going to collect given the fact that 10% we're assuming will not be collectible? Meaning we're assuming all the sales in this period, we're not going to be collecting 10% of them because that's the amount that we typically don't collect based on our past performance, our past history. So we're going to say, all right, if we take the total sales, that would be all the sales that we made in the period that we're looking at here, which would be the 55,000 plus the 60,000 plus the 49,000 plus the 58,000 plus 67,000 plus the 70,000. That would be 359,000. And then we're going to say times the uncollectible portion times 0.1, 10%. And that would give us then, we're not going to collect 35,900, we would assume. And we currently have the balance in there of the 81,100. So 35,900 minus 81,100. So of the 81,100, we think that we're going to collect 45,200 of it.